Welcome everybody back to my channel. My name is A-Aron, and today we're going to discuss what is an asset allocation plan and why do you need an asset allocation plan, and then what is risk tolerance and how do you determine your own personal risk tolerance level, and then finally, if market conditions change, does that change the way that you allocate your asset allocation plan? And those are the things we're going to talk about in this episode of the video. So stay tuned. So we're going to get right to it. First off, we're going to define what is an asset allocation plan. And essentially, an asset allocation plan is just a percentages of the stocks and bonds of your portfolio. So this is the most important step that you can do to start investing. So you don't want to get to the point of actually picking your stocks and mutual funds ahead of time. You want to get your asset allocation plan done ahead of time so you know your percentage of stocks and percentage of bonds. And that is very important to the first step of anything to your own financial plan. So the most important steps is to define what you're investing in, because it's very important that you can stand, this plan can stand the test of time, okay, throughout your investing life and into retirement and past retirement. So that's what an asset allocation plan is and why it's important for you. So let's discuss risk tolerance. Now, the way I look at risk tolerance is how much do you want your portfolio balance to go move up and down? Are you a conservative person? You want income coming in and you want a lower amount of gains and reduce the amount of risk in your portfolio from shooting up and shooting down? Is that the type of investor you are? If you're nearing retirement, your risk tolerance should be pretty conservative, okay? Low risk tolerance. So if you're 10 years past retirement, I would suggest you stick with the conservative type of investments because you need your money to be withdrawed, and you don't want your stock market fluctuations to go up and down so much. So, and then there's the other passive where you're young and you may be more aggressive in your stock views, okay? So then you have like 30 to 40 years to retirement. You can withstand it, the stocks going up 40%, going down 20%, going up 30%. You have time on your side for things to happen. And the point is in this whole video is stick with your plan. Stick with whatever asset allocation you have and start learning more about yourself as far as how much risk tolerance can you handle, because that's very important. Sticking to your plan and not changing it midstream. So what I did is I put together here a chart here. I've got the basically the conservative part of the portfolio and the aggressive, and we'll go through each one of those one by one as far as what you put in those types of plans to match your risk tolerance. So a conservative investor would stick with bonds. They would stick with savings and a checking account. So that's the conservative investors. You may get a puny 1% or 2% a year, but your money is guaranteed in a savings account. And I didn't mention CDs, but CDs are also good too. And you can have different maturities of CDs as well. So, and that's guaranteed money by the FDIC. So you have those types of options. Bonds, you can put it into bond mutual funds and ETFs. I haven't done that at this time. I just stick with like savings and CDs. That gives me the bond kind of quality that I'm looking for as the rates, and it's guaranteed. So checking account as well. If you open some checking accounts, they'll give you a small fee for just having a checking account. So that's in the conservative camp. Now I didn't mention this, is there are some stocks that are fairly conservative. And if you go into the consumer, defensive, and healthcare industries, you can find some stocks that match your characteristics as a conservative investment. And we'll go through that later on in the video. So, and the chart I actually have here is a chart that explains, okay, this is the gain-loss percentages on this axis. And the reason why I put this chart together is because I'm a visual person. I don't know about you guys, but I like to see things in action. It helps me understand what I'm doing. So, get to the chart here. We've got the gain-loss percentages here along the y-axis. And the x-axis, we have the number of years that you have your money to grow. Okay, so as you can see here, we have very steady lows, ups, and downs, and this is along the process of a conservative investor. You're basically guaranteed that money, okay? Now, aggressive. You're going to have some stocks that are very aggressive, like technology stocks. Some types of REITs can be aggressive. And so then you have cryptocurrency, a lot of the Bitcoin and those kinds of investments. It's pretty much of a gamble. I'm just telling you right now, cryptocurrency is a gamble, and I don't even mess with it in my portfolio. It's too aggressive for me. I don't want to take that chance. There's so many other things that you can invest in with a good return. So I don't want to mess with cryptocurrency. Now, some people might. Okay, so I've got the same type of chart here, and I didn't fill the chart out, so I'll fill it out now. Same type of chart here, but what you're going to see is with the aggressive portfolio, you're going to see things go like this. Okay? Over time, you're going to see the money is going to come up. I mean, stocks, aggressive portfolios, 30 to 40 years out, the return is so much higher than with the conservative investments. So if you stay long term, you'll be way up here in your cycle. So you can expect anywhere from 5 to 7% in stocks, and usually in bonds you can get anywhere from 2 to 3% in bonds. And stocks you can get anywhere from 5 to 7%. And it depends on what study. That there's been so many different studies that people have done, but usually 5 to 7% would be pretty good, and that's accounting for inflation. So I usually like to tell people 5 to 7%, and inflation will eat it out. So you're looking at probably 7 to 9% in stocks, and then with inflation, you're looking at 5 to 7% because I give you a 2% inflation level. So this is the kind of chart, again, of what you expect in retirement. So somebody that's young has so much time in their hands, and they can withstand a lot of these ups and downs. But it really depends on how your level is, and can you stick with the plan, because if you start manipulating and change the percentages, it changes your return, okay? So if you have a 2008, 2009 bank crisis again, you don't want to change your asset allocation plan midstream. Okay, you don't want to sell your aggressive stocks in the bear downturn and go to more conservative, because now you're basically buying high and selling low, right? And I know that's hard to do during those bear cycles. I've already been through a couple. Of course, the 2008 bank crisis, the 2000 .com boom and bust. And like, if you start looking at this chart, and I will show you that chart, but if you look at the 50 to 60 year history, it has always recovered. So if you look at the history, it makes you feel better in these bear recessions, because time's on your head and it always comes back. Okay? And I don't like the people that say, well, this time's going to be different. Well, any time could be different. But if you have history on your side, it makes me feel better personally, that we have a lot of time on our side for that money to grow. So it really depends on what your risk tolerance level is, and it matters when are you going to need that money in retirement. If you're not going to need any of that money in retirement, you're doing good getting the income you're coming in through, like, let's say, Social Security or some pension, and you just want this balance to keep going, don't change your allocation to be more conservative. Let it grow. Let it continue to grow, okay? So then the next question is, let's say the market tanks 40%. Does that change the way you allocate? So let's say that you were 80% stocks, 20% cash, and it just hit the 2008-2009 recession. The stocks lost 40% of their value. Okay, does that make you be more aggressive? Like you want to allocate 90% stocks and now 100% stocks? No, because no one knows what the exact timing is going to be on the market. If they do, then I would be running away because they can't tell you. They don't have a crystal ball, just like you don't have a crystal ball. Okay, so if you get to that point, I would not change your asset allocation due to the market, because that's market timing, and you don't want to do that with market timing. You want to judge your own financial position yourself, have confidence that whatever asset allocation you choose and the percentages of conservative and aggressive, and choose which one is best for you over the long term. Now, as you age, it's okay to start getting more conservative if you feel like you need to be conservative. But don't look at the stock returns and give you that advice. Stay away from trying to market time everything, and stick with the plan that you have set up here. Now, you could be tweaks. Of course, there could be little tweaks here and there, but that would be inside of like your conservative actions as far as what you need to invest in your conservative and invest in your aggressive. Okay, so that's that part, and next we'll talk about more details about how you can determine what to put in conservative and what to put in aggressive. Thank you for watching the video so far, and if you like the content, please subscribe to my channel, and also like my video, and post down below if you want to have comments or questions of future videos. And I'm going to throw this out here. If I get 1,000 subscribers, I'm going to release my own asset allocation plan to everybody in the future. So here's the rest of my video. So I'm going to discuss the different investments that you need to have and the risk tolerance level that you decided on earlier. So you have the conservative approach, and here's a sample portfolio. And I did a sample portfolio for aggressive as well. We'll get to that. But the conservative, we have a 50% top total stock market index, which means you're going to hit over 3,000 stocks. Every stock within that index exchange you're going to have a small percentage, and that is weight adjusted. So the higher market cap is actually more towards the large and mid caps. That's how the weight is actually done for these funds. So then you have the 20% in bonds. Now this could be either short, intermediate, or long-term bonds. Now you have to take into consideration with bonds. Now the way I look at bonds is when interest rates rise, bond prices go down. And the way I look at this is if you have a bond, and let's say you have an interest rate of 2%, and let's say next year that interest rate goes up to 3%. Well, the bond that you have 2%, it's hard to sell to somebody that with the rate of 3%, they're not going to buy your bond from you, okay, at 2%. They're just going to go out to the market and buy the 3%. So the reason why your bond is actually priced lower, so that's how your bond prices actually go down in that particular instance. So that's how I look at the bonds. But anyway, you can get like fixed bonds where usually they pay like 2%. You can buy a bond mutual fund if you want, and it would kind of go up and down gradually throughout the years. And like I said, it depends on what the interest rates are, and you can get into those funds. So that's one option. Another thing is, on this particular portfolio, I put 10% in utilities. Now, utilities is a very defensive industry. You're always going to need power in your industries, and they're highly regulated. So money keeps coming in. You're always going to need power, and the governments back these secure utilities up throughout the year. So they are regulated. So you're going to get pretty good returns on them. And usually they're good with the inverse of the stock market. So when stocks do really good, utilities do not as good, but at least you don't lose a lot of money in them. And That's good during bear markets. So that's a conservative approach. 10% in healthcare. We're all going to need healthcare in our lives, and it's a pretty good need as far as what your needs and wants are. This is a need, so a lot of times you'll get healthcare stocks that are pretty conservative. And 10% in consumer defensive, meaning this is the soaps, the everything that you actually need to food, that kind of stuff. So all those needs are going to be under the consumer defensive, and I'll get to that in next videos, where you can pick so many choices right now. And I'm throwing this out here. There's usually a high dividend yield, meaning you're getting a lot more income with these conservative approaches when you buy these stocks. And that's a good idea to get more income, passive income coming through as a dividend, and you keep reinvesting, so that adds up. So this is a conservative portfolio. Now, this is just my ideas here. I'm just explaining what different approaches are depending on your risk tolerance. Don't take this percentage and go back and say, A-Aron said to do this and this and this. This is just an example of how you want to try to understand what you're doing before you start willy-nilly going in, buying stocks left and right. You want to know what you're investing in, what's your risk tolerance, and how can you stick with that plan. So this is the aggressive plan. Aggressive plan, I have, again, 50% in total stock market index, and there's a 20% in small cap value. Now, I posted a video in the first steps to investing. I mentioned how small cap value, if you actually look at a lot of articles, it has proven over time it's very aggressive, but over time you can get some really good returns. So then we have technology, and then 10% in international, and they can be either developed or emerging markets. Now, developed is going to be like Canada and Great Britain. Emerging markets is going to be like China and India. So those are developing markets. Then you can have 10% in REITs. Now, REIT companies, they have to pay 90% of their profits in dividends. So you're going to have a pretty good dividend yield when you actually look at these companies. Now, I don't suggest you actually buy the REITs individually. I suggest you buy the index, which is all the collection of stocks. So then you don't have to do all the research, and you can buy the whole collection. You pay a small expense ratio fee to own that ETF or a mutual fund. So that's what would be my suggestion. So we have the different scenarios of asset allocations planned for conservative and aggressive. Thank you, everybody, for watching the complete video, and please hit subscribe to my channel and like the video, and also post down below if you want to have content that I need to have in future videos. So I appreciate everybody watching, and again, if we get 1,000 subscribers to my channel, I'll go ahead and release my own asset allocation plan to everybody in the future. So we'll see you in next videos, and see you later.